Hot. Welcome to Chapter 16. Option Valuation. Chapter 15 gave us the contracts. We learned what calls and puts allow an investor to do, how expiration payoffs work, and why options can hedge, generate income, or create leverage. Chapter 16 asks the question that makes all of those decisions possible. What should the option be worth before expiration? That question is more subtle than it sounds. An option price is not a single forecast of where a stock will finish. It reflects a range of possible outcomes, the time remaining for those outcomes to occur, the volatility of the underlying asset, interest rates, dividends, and the cost of building an equivalent payoff with other securities. In other words, the price is partly a probability problem, partly a hedging problem, and partly a clock. This is why two calls on the same stock can have very different prices. Change the strike, expiration, or implied volatility, and the economic exposure changes. A $5 premium can be expensive. A $20 premium can be reasonable. The sticker price tells us almost nothing until we understand what distribution and protection it represents. Options also have a special talent for creating false comfort. The maximum loss on a purchase call may be limited to the premium, which sounds friendly, but a 100% loss of the premium is still a 100% loss. The market does not give partial credit because the position came in a smaller package. Our goal is not to turn everyone into an options trader. The goal is to understand the valuation logic well enough to interpret prices, compare strategies, identify inconsistencies, and recognize model risk. And we will move from intrinsic value and time value to a one-period binomial model, then to Black-Scholes, implied volatility, put-call parity, delta, and dynamic hedging. Keep one idea in mind throughout the chapter. A valuation model is a disciplined way to state assumptions. It is not a crystal ball wearing a Greek letter. By the end of this module, you should be able to do 4 things, and each one is practical. First, explain intrinsic value, time value, and the major determinants of option value. Intrinsic value is the amount available from immediate exercise. Time value is everything in the premium above that amount. The distinction matters because an option can have no intrinsic value today and still be valuable if there is enough time and uncertainty for the position to move into the money. Second, describe binomial option pricing logic using replication and hedge ratios. The key insight is not that the stock will literally move to only 2 possible prices. The two-state model is a teaching device. If we can combine stock and borrowing or lending to reproduce the option's payoff in every modeled state, then no arbitrage logic says the option and the replicating portfolio must have the same value today. That is the intellectual bridge from simple payoffs to modern option pricing. Third, interpret the inputs to the Black-Scholes model and explain implied volatility. You do not need to worship the formula or memorize every symbol to use the model intelligently. You do need to know what the inputs mean, which assumptions are doing the heavy lifting, and why the observed option price can be converted into a market-implied volatility estimate. Fourth, apply put-call parity and explain delta, hedging, and portfolio insurance. Put-call parity connects calls, puts, stock, and a risk-free bond through a no arbitrage relationship. Delta tells us how option value changes for a small move in the underlying asset. Dynamic hedging means that the hedge must be adjusted as prices and time change. The word dynamic is important. A hedge that was correct yesterday may be decorative today. The assessment focus is application, interpretation, and judgment. A strong answer does not merely say that volatility raises option value. It explains why the holder benefits from greater upside dispersion while the downside remains limited to the premium. A strong answer does not merely write put-call parity. It identifies the assumptions, calculates the implied price, and explains what transaction costs or dividends could prevent a clean arbitrage. The objective is usable understanding. Formulas matter, but the financial story behind the formula matters more. The chapter is organized around 4 connected questions. The first question is, what drives option value? We will examine the stock price, strike price, volatility, time to expiration, interest rate, and dividends. These variables do not operate independently. A longer expiration matters more when volatility is high. A dividend matters differently for a call than for a put. The investor must understand both direction and interaction. The second question is, how can we price an option through replication? In a simple binomial model, we identify the call's payoff in an up state and a down state. We then choose a stock position and borrowing or lending position that creates those same payoffs. If the option and the synthetic position do the same job in every modeled state, they should have the same price today. Otherwise, traders could buy the cheaper package and sell the more expensive one. The third question is, how does Black-Scholes extend the logic? The model replaces a small number of discrete steps with a continuous time framework. It uses the current stock price, strike, time, interest rate, dividend yield, and volatility to value a European option under a specific set of assumptions. Volatility becomes central because the option holder owns asymmetry. Larger possible movements increase the value of that asymmetry. The fourth question is, how do parity and the Greeks connect the system? Put-call parity links different securities that create equivalent terminal payoffs. Delta, gamma, theta, vega, and RAO describe sensitivities to different inputs. These are not separate vocabulary words floating around the chapter, and they tell a portfolio manager why the position changed and what must be adjusted. Here's the sequence in plain English. Start with the payoff. Build the equivalent exposure. Price the exposure. Observe how the price changes when the inputs change. Then decide whether the premium, hedge, and remaining risk fit the investor's objective. That order prevents a common mistake, beginning with a model output and treating it as a command. Models are better used as structured questions. What assumptions created this price? Which input is most important? What would make the hedge fail? What is the market already charging for uncertainty? The goal is a usable mental model, not a vocabulary list. Finance already has enough acronyms. The least we can ask is that they do some work. This slide brings 6 core concepts together. Intrinsic value is the value from immediate exercise, if exercise would be favorable. For a call, intrinsic value is the greater of 0, or the stock price minus the strike price. For a put, it is the greater of 0 or the strike price minus the stock price. Intrinsic value cannot be negative because the holder has a right, not an obligation. Time value is the option price above intrinsic value. It reflects the possibility that the option becomes more valuable before expiration. Time value is usually larger when more time remains, volatility is higher, and the option is near the money. At expiration, time value goes to 0. The clock eventually wins every argument. Implied volatility is the volatility input that makes an option pricing model equal the observed market price. We start with the premium and solve backward. Implied volatility is therefore a price-derived measure of how much uncertainty the market is charging for. It is not a promise that realized volatility will match the number, and it is not automatically a directional forecast. Put-call parity is a no arbitrage relationship among European calls, European puts, the stock, and a risk-free bond. For a non-dividend paying stock, one common form is call plus present value of the strike equals put plus stock. Both sides create the same payoff at expiration. If prices differ by more than trading and financing costs, an arbitrage may exist. Delta measures the sensitivity of option value to a small change in the underlying price. A call delta might be 0.60, meaning the option price is expected to rise by roughly 60 cents for a $1 stock increase, all else equal, for a small move. Delta is also the hedge ratio in the replication logic. Dynamic hedging means adjusting the hedge as the underlying price, volatility, and time change. Delta does not sit still. Gamma measures how quickly delta changes. Theta measures time decay. Vega measures sensitivity to volatility. Rho measures sensitivity to interest rates. The Greeks are a dashboard, not a guarantee. A strong answer applies the concepts. Suppose a call has a delta of 0.60 and a dealer is short 100 contracts with 100 shares per contract. The approximate share exposure is negative 6,000 shares. A delta hedge might require buying about 6,000 shares, but if the stock moves sharply, gamma changes the delta and the hedge must be updated. The position is not set and forget. It is set, monitor, adjust, and occasionally wonder why the market chose today to become educational. The central lesson is that option valuation and option risk management are the same conversation viewed from two directions. The binomial model gives us the cleanest path into option valuation because every step can be seen. Let us build a one-period example. Suppose a stock is worth $100 today. At the end of the period, it will be either $120 or $90. Consider a European call with a strike price of $110. If the stock rises to $120, the call payoff is $10. If the stock falls to $90, the call payoff is $0. Step 1 is payoffs. We now know the option produces 10 in the upstate and 0 in the downstate. Step 2 is the hedge ratio. We ask how many shares of stock create the same change in value as one call. The call payoff changes by $10 between the two states. The stock price changes by $30. 10 divided by 30 equals 1/3. So the call's delta, or hedge ratio, is 1/3 of a share. Step 3 is financing. 1/3 of a share will be worth $40 in the upstate and $30 in the downstate. We need final payoffs of 10 and 0. Subtract $30 from both outcomes and we get exactly 10 and 0. If the risk-free rate for the period is 10%, borrowing $27.27 today creates a $30 repayment at the end of the period. The replicating portfolio is therefore 1/3 of a share, costing $33.33, financed partly by borrowing $27.27. The net cost is about $6.06. Step 4 is no arbitrage. The call should also be worth approximately $6.06. If the call traded at $8, a trader could sell the expensive call and buy the cheaper replicating portfolio, subject to transaction costs and the model assumptions. If the call traded at $4, the trader could buy the call and take the opposite side of the replicating position. There is another way to get the same answer using risk-neutral probabilities. The stocks up factor is 1.2, the down factor is 0.9, and the risk-free growth factor is 1.1. The risk-neutral probability of the upstate is 2/3. The expected call payoff under that probability is $6.67. Discounting at 10% gives about $6.06. Same answer, different route. Notice what we did not need. We did not need the investor's risk aversion, and we did not need a claim that the real probability of an up move is 2/3. Risk-neutral probability is a pricing device derived from replication and no arbitrage. It is not the market's weather forecast. Step 5 is extend. Divide the period into more steps, and the model can represent more possible paths. As the number of steps becomes large, the binomial framework approaches the continuous logic behind black skulls. Step 6 is monitor. The hedge ratio changes as the stock moves and time passes. A 1/3 delta today may become 0.60 tomorrow or 0.10 after a disappointing announcement. Dynamic hedging is not a philosophical preference. It is the operational consequence of a changing option. The binomial model replaces the question, where will the stock go, with a more disciplined question, what portfolio reproduces the payoff? That is a major improvement. Forecasting gets the headlines. Replication pays the invoice. This slide summarizes the direction of the major call value relationships and gives us the bridge to black skulls. Start with the stock price. A higher stock price makes a call more valuable because the right to buy at a fixed strike becomes more attractive. A higher strike price does the opposite. Paying $100 for the right to buy at 90 is more valuable than paying the same amount for the right to buy at 110. Volatility usually increases the value of both calls and puts. This can feel strange at first because higher volatility means more uncertainty, not necessarily a higher expected stock return. The explanation is asymmetry. The option holder benefits from favorable extreme moves while unfavorable exercise value is floored at 0. The writer accepts the opposite side. More dispersion makes the right more valuable. Time to expiration generally increases option value because more time allows more possible movement, but students should avoid turning more time is better into a universal law without checking dividends, exercise style, and the specific instrument. For a standard call on a non-dividend paying stock, more time is typically valuable. For other structures, the relationship can be more nuanced. Interest rates tend to increase call values and reduce put values, all else equal. A call postpones payment of the strike until exercise. And when rates are higher, delaying that payment is more valuable in present value terms. Dividends generally reduce call value and increase put value because the stock price normally drops by approximately the dividend amount when it goes ex-dividend. Black-Scholes organizes these relationships into a continuous time pricing model. The central inputs are the current stock price, strike price, time to expiration, risk-free rate, dividend yield, and volatility. The output is not a promise about the future. It is a no arbitrage value under assumptions that include continuous trading, frictionless markets, a known risk-free rate, and a particular process for stock returns. Volatility is the input that the market does not hand us directly for the future. Historical volatility looks backward. Implied volatility solves backward from the option price. If a call is more expensive than the model would predict using a 20% volatility assumption, we can raise the volatility input until the model matches the market premium. That matching number is implied volatility. This creates an important distinction. An investor can be correct that a stock will rise and still lose money on a call if the rise is too small, too late, or accompanied by a collapse in implied volatility. Earnings announcements provide a classic example. Options often become expensive before the event because implied volatility rises. After the announcement, uncertainty is resolved and implied volatility can fall sharply. Traders call this volatility crush. The stock may move in the predicted direction while the option still disappoints. The market also does not price every strike with the same implied volatility. After the 1987 crash, equity index options developed a persistent volatility skew with downside protection, often carrying higher implied volatility. So the market learned at considerable expense that tail risk should not be priced as if every return distribution were perfectly polite. The formula is useful, but the real work is interpretation. Which input is driving the premium? Is volatility high relative to its own history? Is the investor buying direction, time, or insurance? What happens if the forecast is right, but the volatility assumption is wrong? An option model can calculate to several decimal places. The market remains under no obligation to behave with that level of manners. Intrinsic value and time value separate what the option is worth now from what the remaining opportunity might be worth. Consider a call with a $100 strike when the stock trades at 105. Immediate exercise would produce $5 of value, so intrinsic value is 5. If the call trades for $9, the remaining $4 is time value. That $4 reflects the possibility that the stock rises further before expiration, along with the effects of volatility, interest rates, and dividends. Now consider a call with the same $100 strike when the stock trades at 95. The call is out of the money, so intrinsic value is 0. If the option trades for $3, the entire premium is time value. The buyer is paying for possibility, not immediate exercise value. Time value is often greatest near the money because uncertainty about final exercise status matters most there. A deep in the money call behaves more like the underlying stock. A deep out of the money call may have a small probability of becoming valuable. Near the strike, relatively small stock movements can materially change the payoff. As expiration approaches, time value tends to decay. This is theta. The decay is not perfectly linear, and it often accelerates near expiration for the money options. The clock is a silent counterparty. It does not send a margin call. It simply keeps collecting. This distinction also helps explain why early exercise is often unattractive for an American call on a non-dividend paying stock. Exercising destroys the remaining time value and requires paying the strike sooner. Selling the option may be better than exercising it. Dividends can change that analysis because a call holder does not receive the dividend unless the call is exercised, and stock is owned before the ex-dividend date. For a put, intrinsic value is strike minus stock price when positive. A put can also carry substantial time value because the stock may fall further. The same decomposition applies. Option price equals intrinsic value plus time value. The practical decision is not simply whether an option is in the money. We need to ask how much of the premium is intrinsic, how much is time value, what assumptions support the time value, and whether the investor has enough time for the thesis to work. My call is in the money is not a complete performance report. Premium paid still exists, transaction costs still exist, and expiration remains stubbornly scheduled. Modern option markets make valuation knowledge more important, not less. What changed? Access became easier. Commission schedules fell. Mobile platforms improved. Option chains became available to almost everyone, and very short-dated contracts attracted more attention. Investors can now express a leverage view in seconds. The friction to enter fell much faster than the complexity of the risk. 0 days to expiration options are a good example. These contracts can be useful for precise hedging and event exposure, but they also carry extreme time sensitivity and rapidly changing delta. A position can move from low delta to nearly stock-like exposure in a short period. Gamma becomes the headline, even when the user has never heard the word. What stayed the same? The contract still has a strike, expiration, premium, exercise rules, and a payoff that must be funded by somebody. Time still decays. Volatility is still priced. Liquidity still matters. Market makers still hedge. A modern app can make the screen feel simple, but the economics remain stubbornly adult. Who benefits? Investors can hedge concentrated positions, define downside, create income strategies, and access exposures that were once operationally difficult. Institutions can transfer volatility and tail risk. Market makers earn spreads and manage inventory. Exchanges and brokers earn activity-based revenue. But every benefit has a counterparty. When one investor buys protection, someone else sells it and manages the resulting risk. This can create feedback. Suppose dealers sell many calls and become short delta. They may buy stock to hedge. If the stock rises, call delta may rise, requiring more stock purchases. Under some conditions, dealer hedging can amplify price movement. The early 2021 meme stock period offered a vivid lesson in the interaction among option demand, short interest, liquidity, and hedging. The episode did not repeal valuation. It made valuation, positioning, and market structure harder to ignore. What risk remains? A low premium can still go to zero. An option can be correctly valued and still lose money. A hedge can fail because delta changes, liquidity disappears, volatility shifts, or the underlying gaps. Implied volatility can overstate or understate realized volatility. Models can underrepresent jumps and tails. Transaction costs can absorb apparent arbitrage. Portfolio insurance provides another historical lesson. Dynamic hedging strategies attempt to reduce equity exposure as markets fall, creating put-like protection. In ordinary conditions, that logic can be manageable. During the 1987 crash, however, many participants tried to sell into the same falling market. The hedge required liquidity precisely when liquidity was disappearing. A synthetic option is only as reliable as the market in which the hedge must be traded. Modernization should therefore produce better questions, not faster speculation. What changed in access? What stayed the same in payoff mechanics? Who earns revenue? Who carries the tail risk? What happens when everyone needs to hedge at once? A trading app can remove the commission. It cannot remove gamma, theta, or consequences. Let us work through the practice case. A call option is out of the money, yet it trades for $5. The stock is volatile, and expiration is 6 months away. First question, why can the option have value despite having no intrinsic value? Because the holder still owns 6 months of possibility. The stock may rise above the strike before expiration. Since a call payoff is floored at 0 but can increase as the stock rises, uncertainty has value to the holder. The full $5 premium is time value at this moment. Second question, which inputs raise time value? The two clearest answers are more volatility and more time to expiration. Higher volatility increases the range of possible favorable outcomes. More time gives those outcomes more opportunity to occur. A higher stock price relative to the strike can also increase call value, as can a higher interest rate, while expected dividends generally reduce call value. Third question, what does implied volatility mean? Implied volatility is the volatility input that makes the pricing model equal the observed $5 premium. We are not observing future volatility directly. We are asking what volatility assumption is consistent with this market price, given the stock price, strike, time, interest rate, and dividends. It is market pricing translated into volatility units. Now let us make the parity question concrete. Suppose the stock trades at $48, the strike is $50, expiration is 6 months, there are no dividends, and the 6-month risk-free rate is consistent with a 4% annual rate. The call trades at $5. For a European option on a non-dividend paying stock, put call parity says call plus present value of the strike equals put plus stock. The present value of $50 due in 6 months is approximately $49.03. 5 plus $49.03 equals $54.03. Subtract the $48 stock price, and the parity implied put value is approximately $6.03. If the otherwise comparable European put traded at about $6.03, the relationship would be aligned. If it traded at $8, the put plus stock side would be roughly $1.97 more expensive than the call plus bond side before spreads, commissions, financing differences, taxes, short sale constraints, and execution risk. A textbook arbitrage would buy the cheaper package and sell the more expensive package. In practice, the trader must verify that the contracts have the same strike and expiration, that exercise style is appropriate, that dividends are handled correctly, and that all legs can actually be executed at the assumed prices. An apparent free lunch often arrives with 4 bid-ask spreads and a seating fee. Pause here and summarize the answer in 4 sentences. 1. The call has value because its 6 months of time and volatility create a chance of finishing in the money. 2. Volatility and time are the main drivers of the time value described in the case. 3. Implied volatility is the model volatility consistent with the $5 market premium. 4. Put-call parity can reveal inconsistent relative pricing by comparing the observed call and put prices with the stock and the present value of the strike. A strong answer also states the remaining risk. The $5 premium can still be lost entirely. High implied volatility can fall. The stock can move too little or too late. Parity can appear violated when the analyst has ignored dividends, early exercise, funding, or actual execution cost. The decision is not whether the call is cheap in dollars. The decision is whether the price is reasonable for the distribution, time, and hedge being purchased. These common mistakes are especially dangerous because each one can sound reasonable in a quick conversation. Mistake 1 is equating a low premium with low risk. A 50-cent option looks inexpensive, but the buyer can lose 100% of the premium. Cheap in dollars is not the same as cheap relative to probability and payoff. Lottery tickets are also inexpensive by unit price. That has never been the strongest part of the investment thesis. Mistake 2 is ignoring volatility. A trader may predict the stock direction correctly and still overpay for the option. Before an earnings release, implied volatility can be elevated. After the event, the uncertainty premium may collapse. The stock rises, the call loses value, and the trader learns that direction was only one item on the exam. Mistake 3 is using black skulls without checking assumptions. The model is designed around a particular return process, continuous hedging, known rates, and frictionless trading. Real markets have jumps, spreads, discrete rebalancing, changing volatility, dividends, and occasional periods when the phrase continuous trading becomes aspirational. Mistake 4 is forgetting dividends and parity relationships. A stock expected to pay dividends is not economically identical to a non-dividend paying stock. The present value of expected dividends affects the relative value of calls and puts. Ignoring the dividend can create an arbitrage that exists only in the analyst's spreadsheet. Mistake 5 is treating delta as constant. Delta changes with the stock price, time, and volatility. Gamma measures that change. A delta neutral position can become directional after a large move. This is why dynamic hedging requires actual dynamics. Add a 6th practical mistake, ignoring liquidity and contract terms. 2 options may have the same theoretical value but very different spreads. Open interest, settlement rules, exercise style, or assignment risk. The price on the screen may be a midpoint that no one is offering to trade. And add a 7th, treating implied volatility as a forecast with guaranteed accuracy. It is a market consistent price input. It can be higher or lower than realized volatility. It may include risk premiums, supply demand effects, crash protection, and balance sheet costs. The solution is not to reject models. The solution is to use them with disciplined humility. Check the payoff, inputs, assumptions, contract, liquidity, and sensitivity. Stress the variables. Ask what happens if volatility falls, the stock gaps, or the hedge cannot be rebalanced. A model is a flashlight. It helps us see the room. It does not make the furniture disappear when we run into it. Here's the knowledge check. The portion of an option price above its intrinsic value is called what? A, time value, B, par value, C, current yield, D, book value. Pause for a moment and answer before moving on. The correct answer is A, time value. Option price can be decomposed into intrinsic value plus time value. Intrinsic value is the value from immediate exercise when the option's in the money. Time value is the additional premium paid for the possibility that the option becomes more favorable before expiration. For example, if a call has $5 of intrinsic value and trades for $8, the time value is $3. If an out-of-the-money call trades for $2, intrinsic value is 0, and the full $2 is time value. Par value belongs to bonds and preferred stock conventions. Current yield is generally annual income divided by price. Book value is an accounting measure of net assets. Those terms are important, but none describes the part of an option premium above immediate exercise value. One extension, time value, does not mean guaranteed future value. It is the market price of remaining possibility under current conditions. As expiration approaches, the remaining time value generally decays toward 0. The clock does not care how emotionally attached the investor has become to the thesis. Let us close with 3 takeaways. First, option value reflects asymmetry, time, volatility, and no arbitrage relationships. The holder of a call or put owns a right with limited downside from exercise and potentially favorable nonlinear payoff. That asymmetry means uncertainty can have positive value. The premium is not just a directional forecast. Second, replication is the intuition behind both binomial pricing and Black-Scholes. In the one-period model, we match the option payoff with stock and borrowing or lending, expand the number of steps, rebalance the hedge, and the same logic becomes the foundation for continuous time valuation. The model price is tied to the cost of creating the payoff, not to a personal opinion about whether the stock is exciting. Third, the Greeks describe sensitivities, not guarantees. Delta estimates stock price sensitivity. Gamma tells us how delta changes. Theta reflects time decay. Vega measures volatility sensitivity. Rho measures interest rate sensitivity. These measures help explain and hedge the position, but they change as the market changes. Put-call parity adds under another control. Equivalent terminal payoffs should have equivalent current prices after accounting for the stock, present value of the strike, dividends, exercise style, and implementation cost. When the relationship appears broken, the first task is to check the assumptions before announcing a free lunch. Portfolio insurance brings the entire chapter together. A protective put purchases downside protection directly. A dynamic hedging strategy attempts to synthesize that protection by changing stock exposure as the market moves. The direct option has a visible premium. The synthetic approach has trading, liquidity, model, and gap risk. Different wrapper, same economic question. What does protection cost, and will it work when needed? After the slides, the homework asks you to analyze option valuation inputs and a parity case. The discussion asks whether an option price should be interpreted as a prediction. The quiz checks the core relationships and terminology. When you review any option position, finish with 5 questions. What payoff is being purchased or written? How much of the premium is intrinsic versus time value? Which input is driving the price? What assumptions support the model? What would change the recommendation? Option valuation is not about finding one perfect number. It is about building a defensible range, understanding the hedge, and knowing which assumption can hurt you first. The formula may fit on one line. The risk usually has a longer paragraph.